हे गाइस, वेलकम टू द चैनल। होप यू आर डूइंग वेल। आज की वीडियो में हम बात करने वाले हैं मॉर्गेज रीफाइनेंस की। और मैं वीडियो अपनी कार से इसलिए बना रहा हूँ क्योंकि मेरी फैमिली आई हुई है एंड देयर इज़ लॉट ऑफ नॉइज़ एट द होम, और मुझे कोई भी ऐसा कॉर्नर नहीं मिला जहाँ पे मैं थोड़ा शांति से बैठ के रिकॉर्डिंग कर सकूँ। सो आई थॉट ऑन माई वे टू ग्रोसरी आई विल क्विकली रिकॉर्ड अ वीडियो इन द क्वाइटनेस ऑफ माई कार. And that's the same reason I could not release a video last week, so apologies for that. They are here with us for only 2 months, so we are trying to go out every weekend, and I'll be making some videos on that as well, where I'm taking my parents. In fact, my parents and my in-laws both are here. We are exploring in and around Atlanta right now, and eventually we want to go down south, but more on that later in subsequent videos. But आज के वीडियो में बात करने वाला हूँ मॉर्गेज रीफाइनेंस की. और रीफाइनेंस is the time when we go to the bank and say,
ए बाबा ए 3 दिन तो बहुत कम टाइम है रे, कम से कम 30 साल का तो टाइम दे रे.
बाबू. Alright, jokes apart, but this is in essence what we are doing as well. We are paying off our existing loan on the house and we are drawing a new loan. But there are primary 2 reasons you will want to refinance. One is reducing your monthly payments, and the second one is that you want to take cash out of your house. I think most of you know what cash out means, but in simple terms, when you are taking cash out of your equity that you have built up in your home. आपने लोन let's say 30 years का लोन लिया था 5 साल पहले और आप उसकी EMIs पे कर रहे हैं, so you're paying down principal, and also in that 5 years your house has gone up in value. तो let's say उस समय जब आपने घर लिया था उसकी वैल्यू $300,000 थी, अब 5 साल में वो बढ़ के $400,000 हो गई है. तो $100,000 इन अप्रिसिएशन प्लस जो भी आपने पे डाउन किया है प्रिंसिपल में वाया योर मंथली पेमेंट्स, यू माइट वांट टू टेक अ फ्रेश लोन आउट ऑफ इट एंड टैप इनटू दैट इक्विटी एंड मेक सम अदर इन्वेस्टमेंट्स विद द मनी यू गेट. ओके, तो जब आप रीफाइनेंस करते हैं तो आपकी मंथली पेमेंट कम कैसे होती है? द फर्स्ट वन इज़ इवन इफ़ यू टेक आउट अ न्यू लोन विद द सेम इंटरेस्ट रेट, आप क्या कर रहे हैं इन अ सेंस यू आर रीसेटिंग योर लोन. फॉर एग्जाम्पल, you have been paying down your house for 5 years and it was a let's say 30-year mortgage. तो अभी उसमें 25 years बचे थे, तो आपको बाकी जो पैसा था बैंक को 25 years में देना था. पर अब आप क्या कर रहे हैं, अब आप एक नया लोन निकाल रहे हैं जिसमें अब आप बैंक को बोल रहे हैं कि मैं ये पैसा 30 years में दूंगा. एंड ऑब्वियसली it can be the same bank or it can be a different bank also. So you're telling your lender that instead of 25 years I am now going to pay you the same money in 30 years. तो उससे आपकी मंथली लायबिलिटी कम हो जाती है even if the interest rate is same. The second way is an obvious reason, if you are refinancing at a lower rate. So एक तो आपने लोन का टाइमिंग रीसेट कर दिया एंड ऊपर से आपका रेट ऑफ इंटरेस्ट कम है. लेट्स से पिछला लोन आपका 3% पे था, अब आपको नया लोन 2% पे मिल रहा है. सो दैट 1% रिडक्शन इन द इंटरेस्ट रेट will definitely reduce your EMI as well. And the third one is an interesting one. This doesn't apply to everybody, but for those of us who have less than 20% equity in our home, what does that mean? Let's say my home is $100,000 worth and I only had paid $10,000 as the down payment, so my equity in my house is 10%. तो उस केसेस में यूनाइटेड स्टेट्स में हमको एक मॉर्गेज इंश्योरेंस लेना पड़ता है, विच इज़ एन एडिशनल कॉस्ट over and beyond your mortgage payments. That is your mortgage principal and interest तो होता ही है, प्लस उसके अगेंस्ट आपको एक mortgage insurance लेना पड़ता है, so that if you default on your mortgage, the bank can secure its interest from that insurance policy. So आप उसका भी एक प्रीमियम दे रहे होते हैं. Let's say for example that is $100 per month. That is a additional wastage of money. I mean it protects only the bank's interest. वो आपके फेवर में कुछ नहीं कर रहा है. It is not protecting your interest. It is just protecting the bank's interest. It is offsetting their risk via insurance policy. और उसकी पेमेंट आप कर रहे होते हो. तो कई बार क्या होता है कि when you take out a fresh mortgage and due to appreciation, let's say आपने 2 साल पहले घर खरीदा था, ड्यू टू अप्रिसिएशन उसकी वैल्यू बढ़ गई. फॉर एग्जांपल द $100,000 हाउस लेट्स से नाउ अप्रिशिएट्स एंड कन्वर्ट्स टू $120,000 वर्थ हाउस. तो 20 grand की अप्रिसिएशन एंड लेट्स से 10,000 आपने डाउन पेमेंट किया था, तो $30,000 इज़ नाउ योर इक्विटी इन द हाउस, विच इज़ more than 20% now, right? 20% of 120K is $24,000, but now you have $30,000 worth of equity. Not even counting the payments that you have made and reduced the principal. Let's say you now only owe $88,000 on it. You paid $2,000 in principal in the 2 years. If you refinance that previous loan, now you will not need to buy a mortgage insurance because now you have more than 20% in your house. Assuming that interest rate same and everything is same and you just bought your property 2 years ago. So you are not getting much by the means of resetting the loan, but that $100 reduction in the monthly payment by virtue of you not paying the mortgage insurance is also a good reason for people to refinance. So that's the third way your monthly payments can reduce. And in general, why would you want your monthly liabilities to be less? Personally, I think your monthly liabilities should be as low as possible. Why? Because there is a financial term that is called debt to income ratio, which the banks look at, and in simple words, it is how much you make versus how much you owe every month. For example, you make $10,000 every month and your liabilities are $5,000. That is, let's say your car payments, your house payments, other bills, and everything is $5,000. So you make $10,000, you pay $5,000 on different things. So your debt to income ratio becomes 50%. So banks would like to see this ratio as low as possible. So that means your income should be high, your debt should be low. So if you reduce your monthly payment by whatever amount, your debt to income ratio improves and you become a better borrower. So you will be not having a hard time to qualify for loans if your debt is low. Alright, so these were the ways how your monthly payment goes down by refinance. The other way where your monthly payment doesn't go down but goes up and you still might to refinance is the cash out part. So if you want to take out some money from your equity that you have built up in your house, you might consider refinancing like I did on my property. So my property went from 150k to more than 200k up in value, and I was able to pull out around $30,000 out of it so that I can now purchase something else with that money. So my monthly payments went up by $200 on that house, but then that was a sensible thing to do because I have now cash available for me to deploy in another asset which will generate passive income over time. So even though my monthly payment went up, I still refinanced. So it's not necessary that monthly payment should go down only then you have to refinance. Sometimes it makes sense to refinance to achieve your other investment goals as well. So once you have decided to refinance, there are a few things that I want you to keep in mind. The first one is interest rate. Now this seems obvious, but a lot of folks don't do that, is that they don't get multiple quotes from different lenders. I don't know why people do that. I would recommend getting at least 3 quotations. I mean, even if you get the first quote and that's the lowest, you don't know if it is the lowest if you haven't looked around, right? So definitely shop around for your mortgage rates. So people avoid taking hard hits on their credit, and that they use as an excuse of not shopping around for lower rates. But let me tell you guys, when you take a first hard hit on your credit report, it opens up a 14-day, I guess it is a 14-day window that opens up, in which you can take additional credit pulls and still not negatively hurt your credit. Ask any experienced lender if they have your best interests in mind. They will ask you to shop around and get a better quote, and they would be happy to beat it. They will never give you their best quotation the first time you go to them. You will always have to come up with a counter quotation and negotiate on it. So definitely negotiate on the interest rate. If interest rate cannot be reduced, there will be other lender credits that they can give to you, and you can save thousands of dollars just by getting those 3 quotations. Guys, very, very important, do that. The second thing is the loan term. Should I take a 15-year loan? Should I take a 20-year loan? Should I take a 30-year loan? So I would say it totally depends. Depends on your investment goals. If you ask me personally, 30-year fixed is good. However, personally, I at times prefer adjustable rate mortgages over fixed mortgages. I know a lot of you would be raising eyebrows on that. I'll make another video and justify in which cases I do that. Okay, so I always take and lean towards 30-year mortgages because my reason is that I want my debt to income ratio to be as low as possible so that I can qualify for more loans if needed. So I want to keep my options open for borrowing. That's why I never sign up for a 15-year term. And the third point, and I think this is the most important point of all I have to say here, very, very important. Understand what points are you paying for the interest rate you are getting. Lenders will lure you with a lower interest rate and they will charge you heck lot of money upfront as points. So if you don't know what points and credits are, in a nutshell, points is a premium that you pay upfront to get a lower interest rate. So they will say, hey, give me $5,000 right now and I will reduce your interest rate by 0.5% or 0.25%. So you have to make that calculation, use your mathematical skills there and see, does it make sense? So hear me out on this. For example, if somebody is saying, give me $2,000 right now and I will reduce your monthly payment by $20. So what essentially that means is you are handing over them $2,000 hard cash right now and they're giving you $20 every month back. I mean, I'm putting it in simplistic terms. I know it will not be exactly $20, it might be $21 or whatever benefit. But what I'm trying to say is the break even of this will be in 6 years or 7 years of time. You will first recover your $2,000 that you paid upfront and then you will start saving, right? Month to month by $20 per month. Now guys, that sounds reasonable if you have to run the mortgage for 30 years, right? Because you might say, yeah, I have a 30-year mortgage and after 6 years I'm profitable, right? I'm paying $2,000 upfront, $20 reduction in payment, sounds good. However, the national average for the length of mortgage that people keep is 5 years. So what that means is you might not run that mortgage for 30 years at all. You might refinance out in 3 years, 4 years, 5 years down the line because let's say your equity builds up or maybe your investment strategy changes or whatsoever, for any damn reason, you might be refinancing well before that 7-year, 8-year mark when this makes sense. And also your $2,000 right now are worth more than $20 a month that I pay you over 7 years again. So all I'm saying is just understand what kind of points you are paying, and if you really intend to pay down the loan fully and free your house, that's another thing. Then it might make sense to pay some money right now to get a reduced interest rate. But honestly, personally, I do not pay any points for a lower interest rate. I pay points only if it makes sense. Let's say they're saying, okay, give me $300 and I'm reducing your monthly payment by $20. Yeah, that makes sense. Okay, in 15-20 payments I broke even and I am saving more than what I paid. Otherwise, $2,000, $3,000, $5,000 for a reduction of 0.25% of interest rate, I don't do that. Personally, I don't do that, and the reason is because I know that I will refinance way before that. So this is the most important point, I think, and also the first one, that get at least 3 quotes and definitely think and understand what credits you are getting for a higher interest rate and what points you are paying for a lower interest rate. Definitely the most important things while refinancing. And in general, I would say if you are breaking even in almost 2 years or maximum 3 years of time, then it makes sense to go with the refinance. What I'm trying to say is there are all sorts of fees associated when you take out a new loan. So let's say you pay $3,000 for refinancing or taking out a new loan. So what's your recovery? How much your monthly payment is getting reduced? If you are refinancing for reduction in monthly payment, so you should understand. Let's say you are reducing the monthly payment by $200 and you're paying $3,000 for a refinance. It absolutely makes sense because you will be breaking even in 1.5 years. You will be recovering that money that you paid for refinance and will be saving much more in the long run. Let's say you run your loan for 5 years, the average length that the loans people run for. So you'll save a good amount of money. But for example, in the final calculations, if it is just you're paying $3,000 for refinance, but your monthly payment reduction is by $25, does it make sense? I would say no. Don't do that. So the sweet spot, I would say, is 2 to 3 years. If you are able to recover whatever cost in refinance in 2 to 3 years, then only it makes sense. Otherwise, no matter what your lender is saying, don't do that. You are not going to run that loan for 15 years, 20 years, trust me. There will be opportunities coming your way. And again, this is not a financial advice. I'm just a guy on YouTube. I'm sharing my perspective on what I do and what I think is important while refinancing. Again, do your own due diligence. At the end of the day, it's your money. You should not follow advice blindly. However, this is something that I have come up with, that 2 to 3 years is the sweet spot. So again, not financial advice. Okay guys, so these were my thoughts on the refinancing process and what I think is important when you consider refinancing. Let me know down below in the comments if you want me to go over a closing disclosure document, because I've seen a lot of folks focus on or not so important items in the closing disclosure. And if you don't know what a closing disclosure is, it is the most important document that a lender would share with you before you close your loan. It describes what loan terms are. So people spend a lot of time focusing on the not so important parts, worrying about those, and not paying so much attention to the parts that are very important, which I just described, right? The interest rates, the points you are paying, the credits you are getting, all those stuff. So let me know in the comments if you want me to go over my closing disclosure of a refinance I just closed. So alright guys, this was today's video. Thank you so much for watching. Please like, share and subscribe. I'll see you in the next one. Until then, as always, stay safe, take care and keep dreaming.